But for now, let's welcome back Jeff Small. He's here to talk more about goal setting and so many other things of which he's knowledgeable. He lives and works in Melbourne, Florida, has over 30 years of experience as a financial advisor. Jeff's a highly sought after speaker who can be seen regularly on shows like Fox Business News, Bloomberg Radio, and his Amazon best-selling book is called Turning Financial Planning Right Side Up. But the most important thing is he's a very close friend of ours, of mine personally, and he's a repeat guest here on The Income Generation. Jeff, welcome back.
Hey, it's great to be back on The Income Generation, Dave.
So for the one guy that made it to the #1 spot on Amazon with your book, when I only made it to the #2 spot, I guess I've got to ask you all the tough questions and challenge you here today. First question, the markets. You know, the markets are high, they've been high, they're showing weakness. We now have 6 months of kind of a narrow sideways channel in the market, not moving forward. How does that apply to our topic today with people's longevity and people's need to be careful?
Well, it really applies to longevity because what retirees don't want to go through is something called the catch-up game, because at some point we all know, even the average consumer from Main Street knows, the market is going to pull back. And so that has a dramatic impact on your money, especially when you're retired. And when you're retired, you're not going back to work to reaccumulate. So you're probably better off avoiding some risk at this point or taking the majority of risk off the shelf.
But that's a general statement, but I guess my question becomes, how does that apply today? Do you think the risks are higher today because you see what's happening in the market? Or do you think there are enough people who just love President Trump that the market's got 2 strong years marching forward? What are your thoughts about that?
Well, that's a long conversation, but in its shortest time frame, Dave, what's driving the market now is not Main Street America. It's not the retiree investor buying stock. It's corporate stock buybacks that are carrying the market. And a few stocks, high technology flyers like Apple and a few other ones, Amazon and Google, that are pushing the market metrics up. And so at some point, corporate stock buybacks will stop. We're on pace for $1 trillion of corporate stock buybacks. Who's going to be buying market stocks when that corporate stock buyback starts to dry up in the next 12 to 18 months? Prices will have to adjust downwards to incentivize buyers to come back into the market. And so that's the #1 driver in the market today is the demand from corporate stock buybacks, which basically they've tenderized the market. They've peppered it for the last 8 to 9 years so the market will grow. And they've been buying $50 billion a month of their own stocks back. At some point, they just can't keep doing that. Yeah. Now, with the Trump tax cuts, they got a huge incentive to buy back billions of dollars of more of tax cuts this year.
But it's not, like I like to say, it's not going to last forever. And eventually, when the music stops, like the great game of musical chairs we both played when we were children, somebody's going to be stuck without a chair, and it's probably not going to be the institutional guys. It's probably going to be the little guys. So, Jeff, please stay with us. We'll be back for another segment. You stay with us, too. We'll be back with a lot more from Jeff Small from Arbor Financial Group. We're here with my good friend Jeff Small from Arbor Financial Group in Melbourne, Florida, and author of the book, Turning Financial Planning Right Side Up. So I have to ask you, real quickly, you know what's your take on this trade war? You know, do you think this trade war could be the one thing that maybe tilts the market when it finally gets out of this trading range and makes it go downward, or do you think we can actually win a trade war?
Well, I think we can win the trade war, Dave. I mean, the EU has already capitulated. Mexico is starting to capitulate and give in as well. Canada will be next, and then China after that, because the economics were at such a disadvantageous state for the United States that things have got to change.
So you think, okay, so you think we can win it, but you're saying you don't think it's enough after this bull market recovery having lasted now almost a decade since 2009. You think even though we could win a trade war, it may not be enough to save us from that next market drop.
No, the trade war is going to be like a pinprick on the economy. We might see, even if we go to a full-blown trade war with China, which is really the only place there could be a trade war at this point, we might see a 0.5% shaved off of GDP. That's not going to rattle the stock market. It will rattle the Dow 30 and some of the largest multinationals that do business in China, but the effect will be short-term and relatively benign. The real pullback will occur once there's going to be less buyers in the market, and that'll happen when corporate America stops buying back as much stock as they're buying now.
Like Mohammed Al-Arian told me on a show just a few weeks ago, the days of buying ETFs are over. It's really about stock picking right now. And that's what he meant. Those multinationals are the ones that could get hurt the worst. So when we come back from the break, I want to talk to you about something that's near and dear to your heart, and that's being debt-free, having a little bit of debt. I know you well enough to know that you're so tight that you squeak when you walk. So we're going to be back to talk with debt more and making sure you don't have a lot of debt into retirement with my good friend, Jeff Small. Stay with us. We'll be right back on The Income Generation. Welcome back to the show, and also a big hearty welcome back for our good friend, Jeff Small. So Jeff, debt. I think all of our Income Generation viewers know why it's important to be as debt-free as they can going into retirement, but why is it so hard for many people?
Well, Dave, people get 30-year mortgages, and it doesn't matter what age you are. A 90-year-old man can get a 30-year-old mortgage today from Bank of America if he wants to, because they're not age discriminatory. But folks have to be more disciplined to get out of debt before they retire if they want to have a retirement that's based on any type of financial longevity potential.
And it's harder today than ever before, because today, I don't know if you see this, is talking to financial advisors every day as I do, or talking to individuals, clients every day as I do. But the reality is that with people now having a greater and greater percentage of their wealth in 401ks and IRAs, it's not like they can just go ahead and take $100,000 and pay off all their debts the day they retire. They'll get killed with taxes, right?
Well, there's no doubt. Paying off a mortgage from a 401k or an IRA is not usually an option. So what they need is a long-term strategy years before they retire to get that mortgage paid off without supplanting or hurting their savings rate. So there's many creative ways to pay off debt. But you definitely, if you're not retired yet, you want to focus on getting your debt down to zero so you can retire debt-free. Then you'll have a financially successful retirement.
That's great advice, and that's great for us as left-brain financial advisors to say, but it's easier said than done. So, Madison Avenue has huge control over us as individuals, and it's so hard. You want what you want to spend money, we're tempted with all these things. Psychologically, how do you coach people to really make that happen? It's one thing to say it, but it's another thing for people to implement it.
Well, I think, everybody's situation is different, so there's lots of customization and tailoring that goes on, Dave. But it's the secret sauce isn't that secret. If you're going to save money and you want to accumulate and you want to pay down debt, you have to save more than you spend, which means you've got to spend less and save as much as possible. And as a general rule, you want to try and save 20 to 25% of what you earn after 401k contributions, after taxes, and after, of course, everything else.
I guess psychologically you just have to focus on, hey, how do I, what my retirement could look like and what it could look like if I stay in debt, and hopefully use that as a motivation. It's like going on a diet, same thing. It's like you always want that piece of pastry, but it's not going to help you with your diet. It's just focusing on the goal, I guess. No silver bullet, right?
No silver bullet, but I don't get the pastry analogy. Are you trying to tell me something?
We'll save that comment for off the air, but Jeff, so since I just must bow to you because you were #1 on Amazon, they can find your book at Amazon, correct?
Correct. Yeah, it's on Amazon, so it wouldn't be #1 there, Dave. It's on Amazon. That's correct.
Turning Financial Planning Right Side Up. Jeff, once again, my pleasure. And you stay with us. We'll be right back here on The Income Generation.